We usually look at a lump sum of money, say $50,000, as a finish line. Like it's the down payment you finally saved up for a house or, I don't know, a year of college tuition.
Right, yeah.
We are conditioned from a really young age to view money as this static object that just, waits to be exchanged for a good or a service. It just sits in an account, completely dormant, until you spend it.
It is entirely dormant. I mean, we think of ourselves as the workforce, right? Trading our time to acquire the money, but we rarely think about how to make the money itself take on a shift.
Exactly. But today, we're flipping that perspective entirely. We're looking at historical data to see what happens when you turn that static pile of cash into a tireless financial workforce. So welcome to this deep dive into time in the market.
Glad to be here. It's a fun topic.
Oh, it really is. Now, a quick but critical reminder before we get into the numbers, this conversation is purely for entertainment and educational purposes.
Yes, absolutely.
We are looking at historical performance and hypothetical scenarios. So please, always seek professional financial advice tailored to your specific situation before making any actual investments.
Yeah, that is absolutely essential to keep in mind. I mean, every investor has a different timeline, a different risk tolerance, and, different financial goals. What works in a historical model might not fit your personal reality.
Right. Oh, and real quick, if you're listening, let us know in the comments if there are any other topics or strategies you'd like us to explore in future deep dives. We love reading those.
We really do. Keep them coming.
Okay, so here is our mission today. We are skipping the basic brochure. We're not going to spend time defining what an ETF is, and we're definitely not going to read off a massive list of every single stock held in the Schwab U.S. Dividend Equity ETF.
Which is the benchmark fund we're using for this data, but yeah, we don't need to list all the holdings.
Right, the SCHD ticker. We don't care about the definitions today.
Exactly, because the specific ticker symbol is honestly less important than the underlying strategy here. We're using that specific fund as our proxy just because it tracks an index that rigorously screens for companies with a minimum of 10 consecutive years of dividend payments.
Alongside strong financial health.
Right, exactly. But we are looking at the mechanics of the strategy today, not pitching the fund itself.
We are going straight into the engine room. Our mission is pure performance mechanics. We are taking a hypothetical $50,000 initial investment, turning on a dividend reinvestment plan, or DRIP, and stress testing it using historical data.
Over 10 and 20-year timelines, yeah.
Yep. And then we're going to pit it against a broader S&P 500 strategy, and finally, look at how it holds up against bonds when the market turns ugly.
It's a phenomenal exercise, honestly. The goal here is to observe the shift from capital accumulation to cash flow generation. We want to see how that static lump sum evolves into a dynamic, compounding income stream without you lifting a single finger.
Okay, let's unpack this. We take $50,000, we buy into a dividend growth strategy, and we turn DRIP on. Meaning, just to be clear, every dividend is automatically used to buy more shares.
Right. And you mentioned the idea of a tireless financial workforce earlier. When you buy into a high-quality dividend growth fund, you are essentially partnering with established, highly profitable American businesses to work for you around the clock.
Like a literal workforce that doesn't sleep.
Exactly. They don't sleep. They don't take holidays. And so let's look at that 10-year timeline. In year one, your 50 grand is working silently in the background. Those companies pay their quarterly dividends, and because you have DRE turned on, those payouts are automatically reinvested.
You're just acquiring more shares quietly.
Right. Silently buying shares in the background. It won't look like much on a monthly statement at first, honestly. The growth in year one or year two feels incredibly slow. But by year 5, the mechanics really start to show off.
What happens at year 5?
Historically, by the 5th year of this specific strategy, your annual dividend income actually grows by about 50% compared to what you received in year 1.
Wow. 50% just from letting it sit.
Yeah. And if we carry that forward to the end of year 10, relying on historical averages, that initial $50,000 investment grows to a total portfolio value of approximately $119,000.
Okay, so you've more than doubled the money. But the income is the real point here, right?
Exactly. The income generated reaches about $4,700 annually, which breaks down to roughly $400 a month.
Okay, I have to stop you there and push back pretty hard on this. Wait, isn't $400 a month kind of modest for a decade of waiting?
I get that a lot, actually.
I mean, I locked up 50 grand for 10 years.
Yeah.
I didn't touch it. And my reward is enough to cover a car payment or maybe utilities. I could drive for a rideshare app 1 weekend a month and make that.
Yeah, that is the exact psychological hurdle that trips people up. What's fascinating here is that you have to look at the underlying mechanism driving that $400. You are experiencing the reality of a double compounding effect.
Double compounding. Okay, break that down for me.
Gladly. So it's not just that you have more shares because of the DRP, that's one layer of compounding, but the second layer is that the underlying companies are also historically raising their actual dividend payouts by about 11% annually.
Oh, wow. So the companies themselves are just deciding to pay out more money per share.
Right. The money is accelerating behind the scenes, so you own more shares, and every single one of those shares is paying you more money each year. The growth is exponential. $400 a month might seem modest, but it's an income stream that is actively growing at a double-digit rate.
Without me doing any extra work. Okay, that makes it sound a lot more powerful.
It is, and since $400 a month is really just the beginning of the snowball, we should look at what happens if you don't touch the money for another decade.
Right, the 20-year timeline. Let's shift to that. Because if the first 10 years is just the snowball gaining traction, what happens when compounding is allowed to run completely wild?
This is where the numbers start to look staggering, honestly. If we project that same $50,000 investment into years 11 through 20, the portfolio value potentially surpasses $300,000.
From 50 grand to over 300 grand.
Yeah, but look at the income stream. That's the real story. It jumps exponentially, exceeding $12,000 annually, or $1,000 monthly.
Here's where it gets really interesting, and I want to push for clarification here. Just to be totally clear, in this scenario, you haven't added a single new dollar from your own pocket since that initial 50K, right?
Not a single dollar.
No monthly contributions, nothing.
Nothing. We assume you just left it alone. The income stream historically doubles every 6 to 7 years without adding new capital.
That is wild.
It is. And unlike a traditional paycheck that requires you to physically clock in, attend meetings or navigate office politics.
Ugh, the worst.
Right. But this $1,000 a month, it arrives whether you are working, sleeping, or on vacation.
Okay, but hearing about these massive growth numbers naturally begs a question. Why not just put that 50 grand into the broader market, like an S&P 500 fund, like VOO or SBY?
Ah, the classic debate. And it's a very valid question.
Because if we look at the raw data, the S&P 500 actually boasts a higher 10-year total return compound annual growth rate. It's about 14.48% compared to SCHD's 12.86%.
That's right. On a spreadsheet, the S&P 500 wins the total return race.
But the yield is completely different, right? The S&P 500's dividend yield is currently sitting around a mere 1.2%, whereas SCHD's yield typically hovers around 3.8%.
Exactly. The S&P 500 is packed with tech giants that reinvest their cash instead of paying it out as dividends.
So what does this all mean? If the broader market technically returns a higher overall percentage, why should you focus on a dividend strategy at all?
Well, comparing funds purely on initial yield or raw price growth completely overlooks human psychology and market volatility.
How so?
Think about the brutal corrections the S&P 500 has experienced. The 2008 financial crisis, the 2020 pandemic drop.
Oh, man. Yeah. Those were terrifying weeks to be checking a portfolio.
Right. And when a $50,000 investment suddenly drops by 30%, the brain triggers a literal fight-or-flight response. It often causes people to panic and sell low.
They just want the pain to stop.
Exactly. But dividend growth strategies provide a psychological anchor because the cash flow continues and often grows even when stock prices fluctuate.
So the portfolio balance on the screen might be bleeding red, but the actual cash hitting your account every quarter is still arriving.
Yes, it shifts your focus from the volatile share price to the reliable income. You don't have to sell a single share to get cash, which keeps the compounding snowball intact.
Okay, that makes a ton of sense.
But
But if we are talking about market crashes and volatility, the traditional advice is to hold bonds for safety. So does a dividend strategy mean you should dump your bonds entirely?
that is a deeply nuanced dilemma, especially recently.
Yeah, let's look at fixed income vehicles. During the 2022 and 2023 Federal Reserve rate hikes, bonds and savings accounts suddenly looked very appealing to investors.
Oh, absolutely. People were getting 5% risk-free.
Right. So why wouldn't I just take the 5% and sleep soundly?
Because you have to contrast that with SCHD's performance. The ETF remained highly attractive compared to those Treasury counterparts because it offers something fixed income doesn't, which is real growth.
Real growth, meaning keeping up with inflation.
Exactly. Because SCHD holds defensive sectors like consumer staples and healthcare, and it screens for quality balance sheets. It has historically acted as a strong downstopper in bear markets compared to broader indexes.
A downstopper. I like that term. Okay, let me try an analogy here to clarify. So holding a bond is like having a salary that never gives you a raise despite inflation, whereas this dividend strategy is like a slightly riskier job that guarantees you an annual raise.
If we connect this to the bigger picture, yeah, I agree with that analogy. While bonds provide nominal safety from price drops, they fail to protect your purchasing power over a 10 or 20-year timeline due to inflation.
It gives 50 grand today, doesn't buy what 50 grand bought 20 years ago.
Not even close. But, and this is important, I would caution that you should only dump bonds if you can truly stomach the inherent volatility of equities.
Because it's still the stock market.
Yes. Your portfolio's paper value will fluctuate even if the dividend income remains robust. If you can't handle seeing the account value drop, you still need bonds.
It's all about knowing your own psychology.
Exactly.
Well, to wrap up this deep dive, we've covered a massive difference today between working for your money and utilizing a 10 or 20-year DRIP strategy.
Yeah, building that income engine that actually outpaces inflation.
Right. So I want to leave you, the listener, with a final thought to mull over. If an initial investment can eventually hire a tireless financial workforce that earns more in a year than many full-time jobs.
Which is an incredible concept.
It really is.
Yeah.
What does that do to your definition of work? Is the ultimate goal of investing not simply to accumulate wealth, but to completely buy back your own time?
That is the ultimate question right there.
Definitely something to explore on your own. And remember, let us know in the comments if there are other topics you want us to dive into. Thanks for hanging out with us, and we'll catch you on the next deep dive.